Guess what, stackers? My 55,000 subscriber silver giveaway entry video is live. You can now enter for a chance to get silver shipped straight to your front doorstep for free. I also give an ounce of silver away once a month to one of my lucky random subscribers. So if you're not subscribed, you're missing out on a chance to win a lot of silver. And like always, may the luckiest stackers win. Hey, what's up, stackers? This is Silver Slayer. Welcome to your daily silver stacking video. Thank you so much for tuning into this very important video. This is the biggest topic concerning precious metals right now. This is talking about inflation, the economy, everything that's happening with fuel and all of that, and how that's affecting the price of precious metals. This is the meat and potatoes that you gotta know right now. So make sure you stick through this whole video because I found a spectacular, an incredible article that breaks everything down that we need to know. So make sure that you stick through this entire video. Make sure you give it a like, share it, because this is some good stuff. I made sure that I did my research and I found the best possible article, and it's called The Paradigm Shift. And yes, that is how you pronounce it. Where are precious metals going? This is some good stuff. The Paradigm Shift. Where are precious metals going? Now, this was written May 17th, 2022. So just, a week ago. Assets markets are crumbling globally, squarely led by skyrocketing US dollar, and the US Federal Reserve seemingly morphed into a highly hawkish institution. This is having, as it always has done historically, a negative effect on precious metals as a result of the first innings of a stock market rout. But something more important is happening here. The elephant in the room is ostensibly the scale of global debt, and the availability of liquidity on a global basis is drying up at an alarming rate. This is, in fact, the fastest contraction in modern history. USA 2-year Treasury debt markets have moved from 0.155% to 2.7% in just 11 months, representing a 17 times move. And here's a chart showing that. 5-year debt has moved from 0.65% to 2.96%, 4.5 times move. Now we know the United States is $29 trillion in debt, and that number's never going to go down. We're trying to get ourselves out of debt by replacing it with more debt. That's like trying to pay off a credit card with another credit card. It's going to catch up. It's like just throw it out of sight, out of mind, right? Everyone gets a stimulus check, but at what cost? It's going to catch up. And what happens when it catches up? The dollar's lost 98% of its original purchasing power, 44% in the last 20 years. Not 97%, not 99%, 98% is a literal and factual number. What happens though when it hits 100%? Every fiat-based system throughout history has fallen, has crashed. It's designed to crash. There's no possible way when we got rid of the gold standard in 1971 that the dollar would survive. It was backed by nothing. And if you look at the dollar's purchasing power or strength, as soon as we got rid of the gold standard in 1971, what do you think happened? Complete decline. Instantly. Broad money supply contraction has been alarming. The US monetary base has fallen from a peak of $6.47 trillion to $5.57 trillion since just mid-December 2021. The twin effects of a rising dollar and rapidly rising US debt rates has been torturous for the offshore debt markets, and the asset markets have snapped lower. This is compounded by China having moved into a new COVID economic lockdown, which has negatively affected the global commodity markets and constrained worldwide supply side logistics chains yet again. This is all set against the backdrop of economic data and forward-looking surveys pointing to a significant global recession. The world is moving towards a depression at a speed of knots, but our analysis is clearly suggesting that we will see yet another change of direction for global monetary policy, back towards monetary expansion, which is already being led by China. This, we suspect, will be the final change that we have been expecting that will lead us from the end of 2022 into the beginning of 2025. The purpose of this report is to help guide our client how to invest and what metrics one should be looking at moving forwards from here on. Precious metals is the only alternative, and I say alternative and not solution because there is no solution to the problem. We are way too deep in a hole to get ourselves out. We're actually digging ourselves out of the hole, meaning we're only going deeper. The only alternative is precious metals. It's the only thing that you can that you can do to preserve your wealth. And that's why it makes me so happy when I see someone email me or comment that, they started stacking silver because of my channel. I've just saved that person, right? So anyways, let's keep moving on. As you can see, this is a great article and it only gets better. Where are we headed? Inflation, asset markets, currencies, commodities, and precious metals. As global asset markets collapse in value, investors and portfolio managers need to step back and understand what is required in terms of portfolio diversification and how to best take advantage of this enormous opportunities and the risk ahead. The scale of the negative macro developments taking place is occurring at a great pace, and for the sake of the length of this article, I will need to be somewhat measured in time spent analyzing some of them in turn. When it comes to gold and broadly a basket of precious metals, the investing public still seems to be fixated with an erroneous fact that as an inflation hedge, and many are confounded that gold has not been outperforming at a time when inflation is skyrocketing globally. And it does make, and that is one of the things, people are like, on pen and paper, precious metals should be through the roof, right? I mean, if we could, go back in history and say, this is what's happening in 2022, listing, COVID and everything. What do you think the price of precious metals are? And we would all say, way higher prices, right? But it's not. So what's happening? Well, a lot goes into that. It's much deeper than just price manipulation from banks placing false buy orders on exchanges, right? Like JP Morgan. It's much deeper than that, much more sinister. But regardless, like I made a video the other day, manipulation and just silver's price in general is going to, especially silver's price, is going to naturally shine as the main factors what influences the price of silver at a greater percentage than other things like stock market volatility or the dollar index or crypto or speculation even is going to pull more. It's like all these little strings are pushing and pulling silver's price at different weights and percentages, but the inevitable, which is the supply deficit, is going to be the strongest factor influencing the price of silver and naturally exposing what it's truly worth. So, to put it simply, gold has never been an inflation hedge. It is a crisis hedge and performs spectacularly well within that construct. Gold has proven to be the preeminent holder of long-term value and wealth over the last 100 years. In the short term, it can be driven negatively by global liquidity issues or asset market capitulations. But in the medium term, its performance goes unquestioned. Now look at gold compared to the S&P total return versus the S&P. Gold is the red line. Central banks are tightening monetary policy at the same time the global commodity shock is intensifying within its overall supercycle. The contraction in liquidity, funding, and broad money supply is taking place at the fastest rate we've seen in 50 years worth of data. This begs the question from investors, where is all this leading to, right? That's the million-dollar question. If we assess the price movements of some of the more publicly aware asset classes and markets into perspective, we can then ascertain what is driving them, where we are headed, and what our clients need to be aware of. Now it goes, January 1st to May 16th. versus the dollar. Then we can look at all these. So looks like Bitcoin's negative 35%, crude oil plus 40%, obviously. Um, yeah, the 2-year treasury, which is the debt yield at plus 228%, gold 0.3% plus, silver negative 8%. Gold, together with other key precious metals, has been caught up in a broader sell-off in commodities, which we believe is entirely misguided, purely paper-driven exchanges driving capitulation and stops, driven in a large part since late April this year. News of China's worsening outbreak, their extreme lockdown policies, and the consequent threat to demand for basic materials, aka a lot of that is just price manipulation. However, China's gold demand, for example, has returned to pre-COVID levels. The extreme volatility and decline seen in the Chinese stock market and real estate markets have sparked investment demand for gold. The gold price today, $1,810, which it's 1853 right now, is lower than it was on February 24th, 2022. Remember, this article was written about a week ago, little over a week ago. But anyways, and that was the day that Russia invaded Ukraine. So this so-called crisis premium for gold, which rose from below $1,900 to over $2,000 initially, appears to have relinquished entirely, despite the ongoing impact of the war in Europe. A growing and worsening geopolitical crisis, massive and rising global inflation, global food panic, shortages, and the UN predicting food famines in 2023, which will almost certainly cause substantial civil unrest in countries like Egypt and across Africa and lead to further sustained food inflation globally. Global funding liquidity, volatility, and debt rollovers. The global debt crisis, the giant elephant in the room, and more importantly, the global liquidity required to support the serviceability of the debt markets. Hence, the funding liquidity conduits are at the very forefront of this equation. Try to say that 10 times fast. I'm pretty good at reading syllables. I mean, man, that was a lot of big words in a very short sentence. Liquidity providers are a complete function of the combination of central bank policies, the banking system, shadow banking, major corporations, as well as global capital flows. Now, global debt is reported at over $300 trillion. That's global. US debt's around $30 trillion, with global average maturity of this debt issued at roughly 5 years. Based on the present global debt levels, that simply translate to circa 60 trillion equivalent global debt must be rolled over on an annual basis. This does not include new debt issuance, as a significant majority of countries around the world continue deficit spending and borrowing. This whole house of cards critically relies on funding liquidity, which is dramatically shrinking, which will further aggravate debt markets, serviceability costs, and continue to spiral. I mean, this is all really just pointing to precious metals being the only alternative, which we already knew, but this article just breaks it down so good. I mean, it really does just get real deep in there and explain why precious metals is the best alternative. They even go into some theories, two scenarios which central banks may adopt. So, psychological trigger within global markets, pre-conclusion. Precious metals will lead the charge from their extreme current undervaluations and will far outperform other asset classes in percentage terms. There we go. I mean, look at that. It does make sense. So let's take a look at this. I just want to highlight some of the main points. So he kind of goes historically. Um, in the big analysis piece in January 2022, this year is really going to be the final entry opportunity to build a strong position in precious metals, saying this is the one of the last entry points you'll have before you miss the boat. Taking advantage to buy the dips using seasonal trends as strong guide. I believe that from 2023 to 2025, the precious metals market's going to absolutely explode, ultimately leading us directly into the new monetary system. Now, I always say triple digit silver by the year 2026. And that's simply well, my theory is more based off the supply deficit. But when you're looking at this side of things as well, it just shows that there's so many different reasons that precious metals have so much potential, right? Whether it's this or that, all of them point towards higher precious metals prices. Then they go into the 1930s. The Great Depression was triggered by policymakers. And then a USA nationalized gold, making it illegal for private ownership in 1933. And then obviously FDR, when he got in office, raised the official price from $20 to $35 an ounce. And that is also when he pushed the gold to silver ratio from 16 to 1 to 75 to 1. Also, when he confiscated everyone's gold, Executive Order 6102, when he said, "Give me all your gold. If you don't, 10 years in prison or a $10,000 fine or both." That was crazy. But anyways, 1970s obviously was when we got rid of the gold standard. And actually, about a century before that's when we got rid of the silver standard. Almost exactly a century before that. So, precious metals finally found their top in 1980 after a 2,700% move higher in gold. And that was pretty crazy. That was when the Hunt brothers cornered the market. And by the way, the Hunt brothers got into silver because gold was banned at the time, so they went into silver in 1980 or 1979. But anyways, 2003 to 2011, that's when we also saw $50 silver as well, and that was from 2008 credit financial crisis led to billion-dollar stimulus, and then 3 years later led to $50 silver. Nowadays, it's credit financial crisis, $1 trillion stimulus, a global pandemic, and then what could that lead silver to today? I mean, it is almost identical when you look at it that way, but a lot of, it's much more extreme nowadays. $1 billion is a lot smaller than $1 trillion. I don't even think the human brain can fathom how much bigger a trillion is than a billion. So, it goes into the conclusion, basically just saying that precious metals are the answer, and he already proved that time and time again. But yeah, I definitely think that. Here we go. Here's his last sentence. So we forecast that by September 2022, we will be entering the last 15% to 20% of the time cycle within precious metals, where revaluation into 2025 will become not only extremely elevated, but where price controls are entirely lost. Basically, when manipulation goes out the door, like I was saying earlier, timing entries and diversification into precious metals with zero third-party liability and fully allocated storage has never been so important, aka buy physical silver, right? Anyways, though, yeah, you can see why I thought this was a spectacular article and why I had to make a video over it, and also why I told you to watch all the way through. If you did watch all the way through, pat yourself on the back. You didn't click off the video within 2 minutes thinking that you know it all or you don't need to know anymore. Closed minds is dangerous in the world of investing, especially with times like this. You got to stay educated, got to be kept up to date. Knowledge is power, especially in the world of investing and in times like this. So, thank you so much for if you're still listening to me talk right now. It's definitely going to pay off. So, yeah, I'm going to wrap this video up here. Remember, if you want a chance to win some silver, click subscribe. My entry video is in the description. Thanks for tuning in. This is Silver Slayer. I'll see you guys soon. Peace.